Welcome to a special edition of No Free Lunch, South Africa's freshest business and tech podcast, with me, your host, Greg Stewart. And today's edition is one of deep reflection on yesterday's medium-term budget speech, presented by an upbeat Finance Minister, Enoch Godongwana. But is his optimism justified, or are the current financial gains a solid foundation for economic growth? Joining me today to unpack this is Ricardo Smith, a prominent South African economist, an investment strategist serving as the Chief Investment Officer at Absa Investments. Welcome to No Free Lunch, Ricardo. Great to have you with me on No Free Lunch.
Thanks for having me, Greg. Looking forward to the discussion.
So let's start off by highlighting some of the key elements presented by the Minister yesterday. A 20 billion rand surplus projected now, a move away from consumption spending and a refocus on infrastructure, perhaps long overdue. Debt-to-income ratio to grow to 77.9%, a low GDP growth rate of just over 1%, growing to 1.8% next year, an inflation target now officially set at 3%. So let's chat about those details. First of all, let's talk about the surplus. A bit of a windfall, really, after in March projecting an absolute deficit in the budget. And then, of course, commodity prices came along and gave them an unexpected boost. But had it not been for the commodity prices, I think we would have been singing a different tune right now.
Yeah, no, for sure. So the gold and platinum prices, have done, quite, great job in adding to that revenue. But not all of it is coming from that. About half of that is coming from VAT. So some additional tax efficiencies at SARS as well, adding to that. We have seen this before post-COVID, where we saw, commodity super cycle where we benefited. And so, participating in that and, getting additional revenue, still expecting an overall deficit in the consolidated budget when you include the cost of servicing debt. However, the primary budget is expected to be in surplus, which is quite important if you are to contain your debt.
Yeah, at least it gives the country a little bit of a breather in terms of servicing that debt. But linked to that is a growing debt, and the projections are that debt to income ratio will spike closer to 80% of GDP, and that's a dangerous situation to be in. The IMF has just highlighted that, in fact, in one of their reports. What's your perspective on that?
Yes, it is a challenge. It's been, a challenge for the past 10, 15 years, where the debt containment plan has been the next 3 years. And every year it's been a rolling 3-year period. And now we are where we are. The one positive with this budget, and this year, in particular, is that the minister has been firm on the idea of containing debt in the current fiscal year. So that goalpost hasn't been shifted from the very first budget that was not tabled up to the third iteration and now the midterm budget. A slight uptick. I think the previous number was 77.4%, now 77.9%. So some movements there, but not a lot, and still committing to the fact that this is the highest peak, and so we will not kick the can down another 3 years, and I think that's positive.
So just in terms of dealing with that debt, I think I saw a number, and I might be wrong. I think it's 22% of our budget or somewhere around there is consumed by just servicing our debt currently. That given, how much wiggle room is there? To me, we've run out of runway on wiggle room. It's not just about servicing that debt. We need to bring that debt down, and we need to be able to start shifting capital into infrastructure development and all those things that can actually grow the economy. How's that going to happen? Let's say, for instance, the commodity super cycle comes to an end, as they always do. Where are we left then in terms of a country? We aren't increasing mining output. Most of the mining revenue increase has been because of the commodity prices. How does that leave us as a country?
This debt problem, as stated, it's really a 15 or so year problem. It has been the fastest growing expenditure item. It was growing in double digits. It's probably fallen off now to about the fourth or fifth, fastest growing. It's now projected to grow at 3.8%, which is, quite a long way from where we were. The fastest growing expenditure item is now economic development, which is what you want. Unfortunately, it's not really growing at, a huge pace. It's growing at a moderate 5% odd. But the order, of priorities is certainly there. And to your point, there isn't a lot of wiggle room to allocate. On the one side, you've got the wage bill. On the other side, you've got the debt. Before you can do anything meaningful, you have to contain your debt. You have to contain your wage bill. You have to ensure efficiency and no fiscal leakages. And that's really where the focus has been. And the proof is in the pudding. And the one thing, yet again, is the fact that the minister is not kicking the can down to the next 3 years we will contain debt. He's reaffirming that in this fiscal year we are containing debt. So we'd like to see that happen. And as we see that happen, it will be quite a positive and starting to see lower and lower debt projections in each, budget report.
The thing about it, getting the country into that level of debt is that the guys that have got us there are not going to be around to see it out and actually pay it off. And I think that's how somehow not, it's just an injustice. But be that as it may, it is probably the most upbeat budget we've had for a while. And we've got, as you said, positive things like infrastructure spend and that starting to become a bigger priority, which is a positive indicator. The move away from consumption spend into infrastructure is important. There was also some indication that the government may look to end in social grants, the social grants that have been ongoing since COVID. It's a bit of a bone of contention. Do you see the government actually phasing those out now properly?
Yeah, look, they have to phase them out, at some point. They were meant to be a temporal relief. It's how do you do it responsibly, because you have created a dependency system. And the challenge is the dependency ratio in the country is constantly increasing and becoming very unstable. And so you need to shift, from a lot of the welfare initiatives to a lot of the developmental initiatives. You need to do it responsibly. You can't cancel them overnight, but it is something that needs to be done. It's no easy task, but it certainly does have to be done, and would expect it to come through. And then we get more and more allocation to economic development. And on that economic front, there is some work, that we've seen, particularly on logistics, the railway. Most of the freight transport is still on the road. We need to get more of that on the rail, but we are getting less congestions on the ports. There's some public-private partnerships. The energy crisis as well, quite a bit, has gone into tackling that problem. And, don't want to jinx it and say it's completely behind us. But, the last time I heard of load shedding, has been quite some time. And then we've got the water crisis that's looming in the background. But some maintenance happening there, and we need to get into that culture of not only fixing but maintaining our infrastructure.
Yeah, that is a critical aspect to it. There's no point in fixing things and then in 2 years we land up in the same situation. The same thing applies to the energy grid that hasn't been maintained, but beyond that, we needed to be expanded. And I didn't see anything in terms of specific allocations towards energy development. I think there was some discussion around the PPE and the solar, developments and so on, the green energy developments. Those developments, though, if we talk about solar and wind, they're important developments, but they don't necessarily fill the gap you need for industrialization. Where is the government going to find money to really upscale its energy capacity?
So there is that 1 trillion infrastructure fund that, they're continuing to commit to over the next 2 or so years. Also the regulatory side, that has gone on in the past couple of years, deregulating the limits on how much private entities can produce, public-private partnerships, allowing certain people to go off grid, just to ease a bit of the pressure. So a lot of things that make sense that have been done, and some lower hanging fruits in terms of just in the power stations themselves, maintaining them, servicing them, making sure, I'm not an engineer, but, making sure the oil is changed, or, and quite interesting to see that turnaround story and how it's actually worked out. Still a lot to be done to expand the grid. 100%, but it is good to work from a place of stability, which is where we are, and then start to think, how do we make this bigger, as opposed to expanding a grid and yet we're still, not producing, sufficient electricity.
Just one thing as a point of interest: debt, the total national debt. They call it public debt, but I find that an irony. It's actually government debt. But the public lands are paying it. So in terms of that debt, does that include the debt, for instance, there's 140 billion odd owed by Transnet, and then there's individual debt owned by municipalities. Is that including or excluding that debt?
It wouldn't be explicitly included, but obviously it is backed by government, so a lot of credit ratings agencies, when they look at it, they'll imply and look through to look at, those promises. So it's not all of it is in there. There was some that was taken over from Eskom just to kind of streamline their efforts. They're trying to manage the balance sheet, manage the income statement, the revenue collection, and then the production, transmission, and distribution of energy. So, there's some entities that were relieved, the biggest one being Eskom, but by and large, it isn't for the remaining ones.
Let's talk a bit about the inflation pegging at 3% and the knock-on effect of that. I have a bit of a prickly point on or opinion on this one, but I'd love to hear what your there has been comments that it creates certainty. I know a lot of people economists were happy about it. What is your perspective on that? And I'll share my opinion afterwards.
Look, from an inflation perspective and a currency perspective, something at some point, has got to give. The trajectory that we were on, where the rand is constantly weakening against our major trading partner economies, simply meant that things would always get increasingly more expensive for us relative to our trading partner economies. Now, whether that means you need to find other trading partners that are more aligned to your policies, but that's, another challenge on its own. But these are the trading partners that we have, and, that's one of the largest rationales to actually bringing it down to 3%. It was a bit of an opportunistic one, because the largest drivers to get inflation as low as now have been the supply side factors. We're seeing global oil prices a bit subdued off the back of geopolitical tensions. We are seeing a weaker dollar due to uncertainty in terms of policy making in the US. And so the rand has done, quite well. So really the governor of the Reserve Bank leading the charge and driving this narrative of a 3% inflation target. There are positives for it, and I think they've been well stated. Long-term stability, long-term strength of currency, and long-term lower interest rates. But there is some pain in the short term, and that does mean a slightly more constrictive monetary policy whilst we anchor this inflation around this 3%, and also as a more constrained fiscal policy where spending is not as loose to try get these costs down. Challenges that may arise here. The one is the wage bill between government, labor, and unions, getting them around this idea of a 3% target. The wage negotiations have been locked in already. And so at the moment, they are growing significantly above this 3% target. So they'll have to bring them to this 3%. Administered costs, energy, and fuel prices, it needs to filter through to say that this is now what the new target is. So those will be some of the challenges. And if we start to see rand weakness and oil rallies, we will see inflation starting to move slightly away from these low levels. But if they do get it right in terms of containing these elements and they do get it right in terms of containing inflation, then as much as there is a bit of pain in the next year, 2 or maybe 3 years, in the long term, we will start to experience, lower inflation and lower interest rates. And we've seen it in the past where the last 5 years, we've averaged 4.5. The last 10 years, we've averaged around 5-6%. The 10 years prior to that, inflation was averaging around 6%. And at some point, it was averaging double digits. So there have been points in time in history where they've structurally broken the level of inflation to a significantly lower one. And I think the governor is seeing this as an opportunity to do just that and potentially leave a legacy for himself. It was surprising from the finance minister to support that because public comments prior to this were slightly different. But, not only did he support it, he effectively changed it from the 3 to 6% to emphatically stating that it is 3%. And some self-interest there, perhaps, because it does mean that he's able to constrain his fiscus as well. In the name of this lower inflation target, and something he's been wanting to do, whether inflation was being targeted at 3 or at 4 or 5, that's been his desire. So there's that as well.
Yeah, I think from my perspective, inflation has already been fairly stable at lower levels. End of last year, we saw it drop to below 3%. This year, it's been 3 or just above 3%. I think the highest was 3.4% this year so far. So it really, in my perspective, it makes very little difference because we get into that point. The things that are driving inflation, to my perspective, are things that the government holds in its own control. The government wages, the electricity prices, the water prices, the municipal service prices, all of these things, which again add costs to other goods and services, the fuel levies, etc., etc. Those things are the things that are spiking inflation. And yet the government's saying, well, but now you as the public have to tighten your belt and you're going to take the pain in the short term to medium term in terms of higher interest rates. And the government is going to land up paying less on its bonds, for instance, because it should bring down the bond yield, which it has already. So the government lands up getting the benefit while consumers just keep paying for the government's indiscriminate spending. And I find that horrendous. The last thing that I my opinion, and again, it's this is my opinion on this, is that as opposed to trying to bring down the bond rates, which benefits the government, they should rather be trying to grow the economy. The government would benefit better and everyone would benefit more with a growing economy. There'd be more taxes, there'd be more jobs, there'd be more opportunities, there'd be more investment if we could get the economy out of its stalled position. And I think that they're doing South Africa a great disservice in terms of not trying to get the economy kick-started, but rather trying to haul this fiscus into this tight little ball that ensures that consumers keep on paying higher interest rates. Comment?
Look, I think we are all paying. To my mind, government is a facilitator. It's the people that we've appointed to run it, but it is ours. So if government debt starts to cost less, then it's also back, positive to us as taxpayers, and also living, within this country. Then there's a bit more money to spend on infrastructure. There's a bit more money to spend on water, on sanity, on safety, on healthcare, etc., etc. It is a tricky one in terms of, do you go for growth or do you go for a bit of austerity cleanup and then try to grow from a healthier place? And I think that's kind of the approach they've gone for. And if you look at the geopolitical tensions that are there at the moment, they're looking at the landscape potentially and thinking it is a tough environment. It's tough to trade with the US. It's tough to trade in Europe. After Brexit, we had a good relationship with the UK and a good relationship with the European Union through the UK. And then all of a sudden we had a difficult relationship from an agricultural perspective with Europe. And so perhaps the approach is, let's clean up, let's consolidate, let's reduce our debt, let's get inflation sustainably tamed, because in as much as it's been low for some of the factors that you've mentioned. By the time we've got a stronger a hold of our fiscus, and by the time we've stabilized our debt and stabilized our interest rates and our inflation, then we're in a better position to actually allocate to some of these things. But whilst that austerity is happening, and I think that's where a lot of the investment drives and the roadshows have been trying to do. Let's try get foreign direct investment to keep things going. Let's participate in things like G20, which is happening now, and let's keep engaging the business community. The challenges, of course, have been that from international investors, the general feedback is they're happy to invest into the South African story, but they want it to be a South African-led initiatives and then co-partner with us. And then the drive turned internally within South Africa between corporates and government, and the same conversation happened to say, corporates are happy to invest in the South African story, but government needs to lead that initiative. And from a South African perspective, one other challenging factor to actually invest directly into the economy is the fact that government bond yields are so attractive. They've come down quite significantly. At some point, they were 12.5%. So if you can get a return of 12.5% borrowing government money, why would you take on additional risk to invest in something that might not pay back? And so even the reduction in the cost of debt for government, on the one hand, it relieves the budget, it relieves taxpayers. It also creates an incentive for investors to say, this at some point, hopefully, if we start to see something, and this is not a forecast, but theoretically, let's say we see a government bond yield at 6%. Now you're a corporate, you're used to see, getting 10, 11, 12%. So now your money has to work and leave, comfortable balance sheets to actually look for opportunities in the local economy. So that's also the idea behind it. It is ambitious, but it is possibly, if they were going to do it, it is a good starting place, given that inflation is not far off from the target. The only challenge is continuity. How long does this take to actually implement? Do we continue on this road? And once inflation is contained, how do we hold government accountable to the idea that we partook in this narrative of a lower inflation target, and we partook in this idea of taking pain from a monetary perspective and from a fiscal perspective? Now inflation is low. Let's get interest rates lower. Let's get efficient allocation and let's get efficient spending, and let's remove a lot of the fiscal leakages that happen across the state-owned entities. So we will need to hold government accountable. I think that part needs to be very clear, that we can't walk this road and clean up and then clean up the fiscus and then, not actually see the results. It would be an own goal from a South African perspective.
Well,
I don't know if I've convinced you.
I'm not entirely convinced, to be honest. I think that there's some, obviously, if you can bring that government debt, there is some benefit. But if you're going to continue to drive the debt as opposed to bring the debt down, there's no purpose in that. And at this point, while the minister's saying, no, we're pegging it at 77.9%, and then that's still going to take us 15, 20 years to reduce that to a manageable level. It really does require very, very strict fiscal discipline. And I'm not sure that with the unions involved and with governments giving 8% increases to government employees, while the average Joe Soap on the street is getting 2 and 3% increases. I'm not sure that that's an entirely equitable situation. This is the ongoing story about a situation where you've got a government that's almost lost touch with the realities of the ground, where people are not just only having smaller increases, they're having to deal with 12, 13, 14% increases in electricity costs every year, and medical aid that's going up double interest, and more than double inflation rates and so on. How does that eventually balance out for the person who's trying to make ends meet, trying to get their kids through school, and still trying to put some money aside for retirement. It's a really hard, harsh environment. And I think that I hope the government will come to realization about what the reality is on the ground is out there, outside of their ivory tower existence, and that this will be an ongoing disciplined approach by the government. Final thoughts from you, Ricardo, before we say farewell. Any last thoughts on thumbs up or thumbs down to the minister?
I think just building on, this conversation, one big thing that government has is, there's a trust deficit between the public and government, and they need to build that back. And so even when the plans are credible and make sense, there's always skepticism because we've seen great plans and, to your point, we've been hit with double-digit growth in administered costs and no salary growth and increases in unemployment. And so the one thing will be holding government accountable. So if we are to lower things like inflation, it must not be a monetary policy initiative. It must be led by fiscal policy, which means government itself must be disciplined. It means state-owned enterprises must be disciplined and costs cannot be passed on to the public. They need to be contained because that's how you actually get inflation down. You don't give it to someone else to manage. And so with each problem being solved, I hope we continue on this trajectory. Energy crisis, we've seen that. Railway, logistics, we are seeing that. Water crisis, we have seen work being done and funds being allocated. We need to see support in the labor-absorbing sectors, mining, manufacturing, construction, agriculture. We need to see unemployment starting to tick down. And I think with every victory that they can actually implement and achieve, a bit of the trust could potentially be won back, and some of their longer-term plans and strategies can gain a bit more faith. And I think that's where the big lack is, because at the end of the day, I think anyone can put a spreadsheet together and say, this is what I think the deficit will be. But it needs to happen.
100%. Ricardo Smith, thank you so much for joining No Free Lunch. I appreciate your insights and your honest responses to my questions, and providing us a bit of insight as to where you see things may be going in the future. Ricardo Smith, thank you very much. I appreciate it.
Thanks for having me.